Thank you everyone again for joining us. My name is Linzi. I'm the Customer Optimization and Community Lead here at Wholesale Investor. It's lovely to meet you. And I think we'll just, kick it off. I would love for everybody to just introduce yourselves and to please just advise us of the firm that you represent and your position that you hold within the firm. And we will start with you, Isabella, please.
Awesome. Thanks, guys. Thank you so much for hosting. My name's Isabella Rich, and I'm a principal investor at Our Innovation Fund. Our Innovation Fund is an early stage VC. We invest primarily in founders and orientate kind of the firm and fund around the people that we back. We have 30 companies in our portfolio, and typical check sizes is around $3 to $5 million as our first check, and then we reserve 50% on for follow-on. My background is I've been at OIF now for 2.5 years. Prior to OIF, I was at BCG, the Boston Consulting Group, based out of the New York office and an Australian office. And prior to that, I had my own little startup, which was a social enterprise in the not-for-profit space.
Wonderful. Thank you, Isabella. Carl, would you like to introduce yourself to us and to our audience?
Sure. Yeah, no problem. Yeah, so I'm Carl Jones. I'm the managing partner at W&T Ventures in New Zealand. We are a pre-seed and seed stage venture capital firm. We're also an incubator as well, so we invest right at the outset, often forming companies. We're focused on deep tech companies, and we're a generalist investor, although we don't invest into pharmaceuticals or human biotech. So we trend a little bit more towards the sort of hardware engineering type stuff, but we also do some artificial intelligence and quite a range of stuff. We've recently just raised our third fund, still relatively small. We raised about 11.5 million New Zealand dollars, but we receive additional capital from the New Zealand government alongside our funds to deploy. So we're deploying around about a little bit over 22 million in the current fund. Currently got, across the three funds we've currently got 18 or 19 companies in the portfolio at the moment, and we're really hands-on at the outset, really help them build from the outset. And typical check size up front is $1 million, and then we'll reserve capital for follow-on as well, but obviously we don't go very far with 11.5 million, so we tend to run out of gas at around the Series A and hand it over directly to our LPs often, and others, both nationally and internationally. So, and then recycle ourselves back at the front end. Yeah.
Wonderful. Thank you, Carl. Over to you, Kevin.
Thank you very much. It's good to be in Australia this morning, place where I studied. I'm an entrepreneur, investor, entrepreneurship expert at Oxford Side Business School, founder and director of Consilience Ventures, which is a venture investing platform turning VCs, family offices, and angel networks into end-to-end startup accelerators. We specialize in tokenizing sweat equity to increase speed for founders. We support pre-seed and seed stage deep tech startups because typically they need more than money. They need expertise, very specific expertise globally, and they typically take longer to generate revenue. Therefore, we as our model can support those companies for a longer period of time. Our initial investment is £300,000, but we continue funding the business on an ongoing basis. And I guess I spend my time trying to improve the lives of entrepreneurs by making the venture capital market more inclusive, more transparent, and more efficient for all.
Thank you, Kevin. Over to you, Vela.
Hi, my name is Vela Georgiev. I'm the COO and operating partner at Tenacious Ventures. Tenacious Ventures is Australia's first and only specialised agri-food tech VC firm. We support early stage startups with tech-enabled business models that are helping agriculture transition to a carbon neutral and climate change resilient future. We are an impact fund, so we have an impact mandate. I think we're probably the youngest fund here. So we closed, I had our first close last year, 2020, March. We're a $35 million fund. We've 7 portfolio companies to date. And a check size somewhere between sort of 500 to a mil or thereabouts. As a sector-specific fund, we are very much sort of high conviction, high support investors. We've got deep experience in the space, and we're very hands-on in helping our portfolio through that journey.
Thank you so much. What is so nice about our panelists here today is your funds generally invest in early stage and seed companies. I'd like to hear a little bit about your experiences, why you've chosen to do that, and also what are the risks that some investors might find in investing in these early stage companies. Bella, you're on screen, so over to you.
I guess there's a little bit of an element of where we can deploy our expertise to have maximum impact, but also find that it is often the early stages where startups struggle to sort of get that funding, and so looking for those true believers, people who are both behind the founder and the idea, and so for us there's a very specific appeal of being in that space and looking at what technology and innovation could enable fantastic impact, but at the same time the capability of the founders and the vision that they have to execute something. So it's a pretty unique position versus perhaps somewhere down the line where it's converts a little bit more to unit economics and those types of things. So it's a different kind of I guess sort of investment proposition, but with that also different risks. And maybe I'll let some of the other panelists talk about that element a bit more.
Absolutely. I see you smiling there, Isabella. I know you've had a long history in early stage companies. Do you want to tell us a bit about your experience and also what risks you've seen and how investors can really see those red flags before it's a bit too late?
Yeah, it's echo Bella's points. I think when you're investing in seed stage, you're really backing the founder and the person. So typically we see companies that there's a couple of people in the founding team, probably head of sales and CTO and the team around them, but really where what our job is to help them build out that team, B, scale the initial customers and sales that they have to make it kind of a really scalable and well-run sales and marketing function, and then C, kind of grow internationally. Australia is tiny in comparison to the US, and typically where we invest, which is B2B software and marketplaces, it's a great position to be in Australia to refine product market fit, get all your ducks in a row, and then use that as a platform to launch overseas.
And do you find do you find that the companies really need to be revenue driving in Australia before they expand? Do you actually want to see that demonstration of ability, or do they come and say the market's too small, we need to expand, and then we will be able to show you those returns?
I think it's different for different industries. For example, ag, I think, would have a little bit of a different view. For B2B software and marketplaces and even consumer, you typically revenue is the easiest proxy because it shows that you can sell and that customers want the product. But I think there are a number of other proxies that you can use, which is, customer acquisition, customer growth, and things like that, you see there's a lot of companies that don't start off with revenue, but, harness a huge customer base and then kind of work out where they can charge and where they can upsell customers. So typically, to answer your question directly, the market isn't too small in Australia to demonstrate those things, and usually you can build a pretty good base before then you go overseas.
Thank you. And Carl, what do you think about that, given that New Zealand is quite small? So that would be a challenge from a market perspective, given your experience. What do you want to see from the companies you invest in?
Yeah, New Zealand isn't a market, right? I mean, we're smaller than probably Sydney just about these days. Yeah, look, I mean, they need to have a global view from day one, really. But in saying that, New Zealand is also quite a good testing ground initially, just to roll it out in a safe environment. I think many of our founders, we're not that small, but a lot of them kind of know the customers, and you can get in front of them pretty easily. So showing customer traction in New Zealand is okay, and it's good to bring revenue in, but realistically, until they get offshore, I think any real serious investor kind of somewhat discounts the revenue traction in New Zealand. I might be causing offence here. But we're a pre-revenue investor at the outset, right? So we always invest into pre-revenue companies. So we often don't have the luxury, or we always don't have the luxury of reviewing traction to make an assessment as to whether there's a good opportunity here. So there's a lot of additional elements of risk where trying to determine whether someone's even going to want to buy what the technology platform is creating in the first place. There's some real challenges around that. And then on occasion, we're also we're spinning technology out of universities and research institutes. So, sometimes there's no team either. So we're not even investing in founders. We're literally investing in, the potential of some IP. So, we really see ourselves as being, the building blocks, and really, diving quite deeply at the outset to make sure the companies are built really well. Because if they're not, those, if you miss something in there, then that may not crop up for a few years until the Series A or Series B, and that's sort of a bit too late by then. So, really strong focus on intellectual property from our perspective, really diving deep on the potential of the market. Like any other good company, market validation is absolutely critical, but you've got to do it in quite a different way, I think, from the outset. So it's a lot of additional risk factors, but overall, risk also potentially comes with reward, right?
And with your with your investors that want to invest into the fund, how do you express that risk to them, that they are aware that sometimes these are just ideas?
Yeah, I think it's interesting. We, being in the deep tech space, it's I think there's a pretty strong trend in the last, let's call it five or so years towards deep tech investing, and I think it's a little bit hand in hand with impact investing as well, right? We're not an impact investor, but they kind of go hand in hand to some degree, because you're making quite significant changes in the world where you can do. And so I think from that perspective, that's certainly attracting a certain type of investor into the funds. We're also fortunate in the sense that we do get government capital to de-risk some of that. We're part of New Zealand government sort of Callaghan Innovation Technology Incubator Program. So we the $1 million that we get some government funding to help de-risk some of that for the investors, and that naturally makes it an attractive opportunity. But we can't stand on that in our own, without standing on our own 2 feet. So we're, even though we are investing that early, we're still a very high conviction investor. You know, we're not a spray and pray investor. We dive deeply in a whole range of areas before we get in. And so, you know, we would only really do sort of 5 to 7 companies per year, you know, and we'd look at, this might be small internationally, but, you know, we'd look at about 350, 400 companies per year.
Right.
So we're quite selective, right?
Yeah.
Yeah. And I think you kind of have to be, right? And you're never going to get them all right. But you know, hopefully from the back of that, our hit rate is certainly much higher so far of successes. But you know, we're 7 years old. We're still relatively early in our own journey. You don't tend to raise a third fund without doing okay in your first couple of funds.
Exactly. Track record, right? Is what we want from our founders, but we also want that from our funds. Exactly. And over to you, Kevin. How do you really mitigate that risk with your investment fund, and also given, you know, you use technology actually to analyze these deals? Do you want to tell us a little bit about that, because we're finding this industry is still a little bit paper driven?
Yeah, the industry is completely paper driven. It's back in the 80s when in the stock market, where people were making orders with a piece of paper and a cell phone. We've added Excel to this, and that's pretty much kind of the tech stack of most VCs. So we've created the whole tech stack to power the VC industry, to leverage digital transformation without having to move away from the traditional model, the traditional LPA. So we see ourselves as the plumbers, the plumbers of the VC market. We are helping VCs to leverage their communities, to engage their communities at a much more deeper level than you would have on Twitter and LinkedIn. And we are creating an incentive model at the back of this to let those VCs manage their communities, incentivize their communities, so that everybody can participate, or the most qualified people can participate in the selection of the company. So this is where the technology comes in. It's effectively the process. The whole process is digitized. How do you find a company? How do you understand sentiment analysis? How do you identify the gaps of that company very early on? Because like most of my peers right now, we invest very early, and there are gaps all over the places. I've been working with many entrepreneurs for the past 7 years or so, and I've never seen any company perfect. Perfection does not exist even in VCs. So what we can do is we can try to be quite humble about how we approach investing in startups, and look at how where the risks are and where the gaps are in the company, and do something very early on about those gaps. And this is where our network effect comes in. So combination of technology and network effect. Here, when we have a company that has gaps, we identify it very quickly, and we identify the solution very quickly as well. And that can be someone in New Zealand, or that can be someone somewhere in Sri Lanka or whatever. We don't really care. What matters is the expertise, it's the skill, it's the availability, and it's the alignments with the company's vision, because everybody get paid with the shares of the portfolio, as I explained. The fund is tokenized. So we're focusing mostly on deep tech and med tech and fintech for various reasons. There are not a lot of VCs that can do the three altogether, and you are also very well exposed to very interesting technology at the intersection of fintech and medtech as well. You can package IPs and create insurance product as an example. But fintech and medtech are big market, so we're focusing on this because we've got the network, and because the market is growing. So that's how we're looking at de-risking portfolio and empowering VCs and portfolio companies.
And what did you see was the biggest trend during 2021? I guess that will be our pandemic years. What did you see was the biggest trending industry, and also how did your pre-seed companies actually navigate the pandemic?
Question for me?
Yeah.
Thank you, thank you, Linzi. Without any question, the sector, the most funded sector in 2021 is fintech. It has doubled the investment in 2020. So I think it's a record of 50 plus billion in H1 2020. So it's by far the most funded industry. It has pros and cons, right? I think we shouldn't be too biased towards only funding fintech companies, because of course, there are only so many dollars, believe it or not. I'm not going to make any comment about the central banks. No, but what we should be able to do as investors is to understand that our money is and the money of our investors. It's a way for voting. We're voting for what we want to see, how we want to see. We're voting to shape the world in the next 5, 10, 20 years. And if we're only putting our dollars in fintech startups, then we obviously are going to have problems in other sectors. So I'm a massive believer in trying to equalize how capital is distributed across industries. One of them being fintech, agri-tech, and energy and impact. I think we should be able to do that. So from our standpoint, we are completely agnostic. We're growing our network and our communities to do more in all of the sectors. So we meant to be completely sector agnostic.
And that's a nice segue into you, Vela. How did you find the agri-tech sector, especially in these pre-seed stage companies? How did they navigate through the pandemic years?
I think it's a little bit interesting in that we closed our first close was at the start of the pandemic. Our final close was this year. So we as a fund were also completing that last round of fundraising during the pandemic. So from that perspective, I guess, I'm very appreciative of the journey that some of our startups were having to go on during that time. But equally, the pandemic has probably brought a little bit more to the forefront of everyone's mind, sort of the impact of climate change. So population growth, water scarcity, climate variability, all of these things are sort of more common talking points, and people are definitely more aware of that. And I guess to some extent that ability for consumers to vote, to some extent, as Kevin said, and for that future to be shaped. So that sort of push-pull effect of consumers being more aware of how their food gets produced, the carbon emissions that might be associated with that production. What is the food producer doing to minimize their emissions? How are they engaging across a supply chain and those types of things? So in terms of probably sectors that we've sort of seen this year, in partly, might be sort of around the carbon emissions, definitely. So there's been a bit around that space, and as well around the alternate protein. And I think sort of those two tend to speak a little bit to where people have found themselves or what they're thinking about in the last 12 months. But also, I think as a industry, agriculture to some extent has also been heavily impacted by the pandemic in perhaps ways that people don't necessarily see. So labor shortages on farms to be able to pick fruit, and sort of produce it, and that necessitating both innovation to not only enable automatic picking or those types of things, but then also what happens along the value chain to extend life, or the waste that might be associated with food and those types of things. So there's quite a lot of disruption and the like that has been highlighted or sort of gaps. So it'll be interesting to see in even maybe the next 12 months what sort of comes through as investments towards are precipitated by the pandemic itself.
Yeah, absolutely. And especially, I know it's a little bit out of AgTech, but in terms of how we recycle plastic, we were doing so well. We got rid of the straws, we got rid of single-use plastic, and then we went with full single-use PPE garments made of plastic. Where are we? Have you seen any? Where are we in trying to mitigate all that type of plastic that we've probably produced more plastic in the last 2 years than we have in the last 20?
So it's quite interesting. We do get quite a number of startups approaching us with innovative packaging solutions or those types of things. But at the same time, we also have so for one of our investment companies, for instance, GoTerra is essentially the processes waste, and they have come up with a modular solution for the processing of waste using insects, and the ability of insects to process that kind of various waste streams in an efficient manner and those types of things. So there is, I guess, sort of the two things of innovative packaging, those sort of things, but fundamentally there is also going to be some type of waste, and we need innovative ways in processing that as well. What we have found with some of the packaging and those types of is sort of assessing essentially the venture scale nature of that solution, but also how it sort of sits along that value chain. So there's often, I guess, a bit of deep tech that might come along in coming up with a innovative solution, but being able to have the adoption happen along the supply chain for it to be realized can sometimes be where the challenge is. So taking the perfectly valid idea or something that's got potential, but then actually having that product market fit and the business model is sometimes where the difficulty is for us.
Thank you. How did you find it in New Zealand, Carl, with your customers? Because, almost a lot of your revenue comes from your tourists.
Yeah. Look, I mean, bulk of my companies are pre-revenue anyway, so that it wasn't an issue for them. Right? They were quite used to surviving on very little money and kind of muddling through, to be honest. Look, I mean, it's I think it's probably more challenging for our companies when they're trying to expand globally, and you've got a team here in New Zealand, trying to establish a manufacturing plant in Australia or the UK, and certainly with our border controls that we've got in place, where it's easy enough to get out of the country, but actually it's the getting back into New Zealand is the hard part, right? The shut down. They might have families and they've been away for a month, and then they've got to spend 2 weeks in a quarantine system, and that starts to become pretty challenging to manage, right? And then not least, the attracting talent into the country, which I think that's a global problem, right? Is talent shortage, and exacerbated by a country of 5 million people as well. So finding innovative ways to deal with that, I think, has been really interesting. There's a lot more usage of offshore developer teams, for example, in Ukraine and Philippines and elsewhere. So I think we're seeing quite a bit of a trend around that. From a customer perspective, though, at the end of the day, many of our companies just have to get offshore. I think one of our faults here in New Zealand potentially is we're running behind in terms of opening up and just getting on with it, because I think we have to. I don't know what it's like in Australia, but and it's a scary thing for a lot of people here, because we haven't borne the brunt of it of the rest of the world have. So but some of our founders are just getting offshore and getting partnerships done and doing deals and getting it done, and then they're back in, and it's great to see, and it really I guess shows the commitment of the founders, and full credit to them. It's a tough environment, and when you're trying to do a startup, which is damn tough anyway, it's just tough. It's hard work, but
And Isabella, how did your companies go, and your sort of sectors go during the pandemic years?
Yeah, we were very lucky, and I can't say it was all by design, but 8 of the 12 portfolio companies in our first fund were remote working using some kind. So companies such as Go1 that provides corporate learnings and is kind of the Netflix for corporate learnings. They recently just raised from SoftBank, to Onboarder, which was actually an onboarding tool where in COVID they very quickly kind of added a whole kind of stream around onboarding and offboarding and COVID related kind of onboarding issues specifically. So in that sense, yeah, it was a very interesting time. We also were raising our second fund kind of the week before COVID started, and we got together and for 2 hours kind of went through the portfolio and go, okay, well, what's, you know, COVID scenarios, what are the kind of, if they decrease revenue over the next 12 months by 50%, what does that mean? How do we help them in these times? And kind of 6 months later, I think 6 of them had their record quarters. So that was more luck than by design. But for what we're seeing, I think, you know, 3 themes come to light. I think, you know, remote work, definitely full steam ahead. We've recently invested in a company called, and gosh, I'm now having a mind blank, Vouch For, which allows companies to do kind of remote customer testimonials through video format. And they've seen incredible growth during COVID. I think the second theme is I would echo the fintech, but from a crypto stance. I think we're at the beginning of an evolution of decentralized finance, and I think we're at the, you know, we're just skimming the surface at the moment in terms of the use cases for blockchains, but then you kind of go into NFTs and all of these applications where people are still trying to work out product market fit. But, you know, just in terms of ticketing, you take that alone, and the benefits of, you know, NFTs and what they can provide to ticketing is huge. The third, I would say, was in gaming. And I think gaming is seeing a very similar evolution to what the internet did 20 years ago. There was a great graph by Morgan Stanley that they put out, you know, 2004, 2005, which talked to eyeballs on the internet versus advertising dollars. And I think we're seeing the same now, where if you look at eyeballs in the gaming ecosystem, it's just astronomical in comparison to any other industry that I've seen. But people are just working out how to monetize and what are the kind of infrastructure plays and niches that you can go into. So for example, there's a company called mod.io. They provide the infrastructure for individuals to develop what's called a mod, which is like an element to the game that is a user-generated thing that all gamers can use. And so I think there's a couple of layers of this gaming world, one being advertising and 2 being kind of the infrastructure layer that we're just going to see more and more of.
Now, something that I wanted to ask you is, so with those companies that have experienced something like exponential growth during COVID, how do they then manage their expectations coming out of the pandemic that exponential growth is something they're not going to have? And from their perspective, in terms of coming back to you as a VC to invest in them, do you have those expectations that they continue those massive growth cycles?
Yeah, it's interesting. You speak to any kind of technology equity investors in the public markets as well, and particularly around internet marketplaces and consumer goods. It's this, like, I don't think anyone really fully knows how to forecast, you know, from here on in. I think we operate in a different space to equity investors, where they're really having to kind of get their forecast down to, you know, an nth degree, where what we say to ourselves is, you know, how big is this market? How much do they capture today? And you know, if they experience, let's call it 70% of the growth, or half, you know, 50% of the growth that they did last year, like, they're probably still very underpenetrated in massive markets. So it's, you know, having a fund life, which is a 13-year fund, makes it's less about the kind of next quarter's earnings and more about where you think the opportunity can be over the long term.
What do you think about that, Kevin? Given that, you know, your main industry was fintech, which exploded, is to really understand what are the revenue models now outside of exponential growth? Because I've been through exponential growth, and you can really you really want to start to bank on it, but you can't.
Yeah, well, you have that level of unpredictability when you're coming early on, and you need to be very comfortable with the fact that startups may have to pivot and change their revenue model and their distribution and so on. So there's no magic, or there's no science. It's only going through the usual test and learn kind of feedback loop. So some companies are sticking with the same model. Some have benefited from COVID and have experienced growth beyond expectations, and some had more challenge to adapt to the situation. I think you can only appreciate that your strategy is as good as your first punch in the face, right? And that's pretty much why I think nobody could anticipate COVID, but by working closely with the companies and trying to bring people who have gone through crisis, we invest in. We don't have that kind of any restriction around age, but the majority of the founders we've invested in, they are somewhere between their 30 and 50s. But the network that we have, they are probably our global network of 250 plus. Experts, they probably have about 30 to 40 years of experience, and therefore they've seen a few crises. And there's nothing better than someone who's seen a few crises to tell you how even if they are not the same crisis. I'm by no means comparing GFC with COVID-19, but I think when you have been in tech for 30 plus years, and you know what it's like to go through the dot-com bubble, for example, then you have some self-defense mechanism that are already there for you. And the truth is that most founders, especially when I'm thinking of Carl, where I suspect that the majority of the PhDs don't have 40 or 50 years of experience, then they have. I'm sure there are some exceptions. I'm by no means making any generalization here, but when of universities, and you've got those very young people full of energy, but they are naive, right? And we all were when we were coming out of university. So bringing people bringing the wisdom around them, and making sure that they don't feel like we are judging them to assess whether we are going to reinvest. It's about having that very vertical relationship as opposed to horizontal relationship versus vertical relationship. We're here to help. We're here to help those companies, and we want them to tell us where their pains are, and we're not going to use that against them at the next round. We really want them to understand that we want their best. It's in our interest to know where they need help. Because we've got the bandwidth and the network to help, and that's something that is very important to cultivate within the portfolio. It's that proximity with the founders, no matter what you're going through, basically.
Is that why you only choose a handful out of hundreds to invest in?
Well, so we've reviewed about somewhere between 800 to 1,000 deal a year. But the truth is that there about 50% of that are not even relevant to us. And so we literally looking at in depth about 200 deals a year in depth. And that is, and we've made 7 investments. But there is also that chemistry that you're looking for as well. That even if the business is very good, you need to work with founders that want to work with you and not just want to take your cash and run away. we've seen many founders, they think they've got it all sorted because they've been through some of those universities and they got it and they're going to rock it. And we're like, well, you're doing your first startup, ask the ones that have done a few and you'll see if that's easy. And so we're laughing sometimes because you can try to open their mind, but some founders just don't want to work with you. And we've got pretty clear cut on that. If you don't want to work with us because you think you don't need us and you just need the money raised from someone who's just going to give you the money, that's not our ethos.
Yeah, a lot of our founders, want to know why you won't just invest on the spot. A lot of them have that expectation. Is there some advice you can give our audience today in how to really get into the mindset of the investor? Because for the most part, we're hearing the same thing from our investor groups coming back, is we want partnerships, not just, a signed check.
Yeah. So is that for me first to answer,
Yes.
Linzi? Yeah. So I guess our model is very typical once again, because we're starting from the problem and not from the emotional trigger, because this is a massive, exciting opportunity. We're very much looking at, okay, what is the problem you're trying to solve? Are you in love with the problem? Do you understand how big this problem is for the market that you are addressing? Well, that's not where we stop. We're looking at, okay, what can go bad here? And our job is to reduce the risk. So what we love about the founders that are applying to us, and when they straightforward on the first call, they say, guys, I'm doing this. I love the problem. The market is so big, but these are all of the problems I need to get there. And they start by telling us the problems, because we are entrepreneurs, we are operators. We know that there are problems. If you're trying to hide, and if you're trying to say, oh, everything is fine, I'm flying right now, give me the cash, I just need a view. We're going to say BS. We know it's not true. We've done it before. So we're just going to have very, very honest relationship with the founder, saying, tell us where are your biggest pains right now. And it's not because this is, by the way, we don't reject startups because they have many problems, because we've got the network to solve those problems. So we're very comfortable investing in companies that have problems. What we're not comfortable is, we are not comfortable investing in founders that they think they don't have any problem.
That's amazing. Vela, what do you think about that from that social impact perspective? Is that something that you're also looking for in your founders?
Yeah, I guess probably the way I view it is that when each time we make an investment, we're taking a risk, right? We're taking a gamble on the founder, on you, essentially, the people listening to this panel. But we also have to do right by our investors. Right? So we as a firm are essentially the conduit between our investors and the founders. And so our investors have entrusted us, and in particular as a sector-specific fund, as people who are knowledgeable within this space, to find opportunities that allow capital to be deployed to meet a specific objective. And in our case, that's to work towards a climate-resistant, resilient future, and to find the best opportunities that enable that impact. And so when we look at the startups and when we talk to them, there is, like Kevin said, this deep understanding of the industry and the problem. But then there is also the founder. It's early stage. It's seed. It's there isn't sometimes attraction or the revenue or the metrics there to speak to that. So it's about the founder themselves and the characteristics of the team, that they're continuously learning and coachable, that we can build a relationship with them, that we can have a partnership where we can support them not only with our network, but that interpersonal relationship. So them wanting to work with us is just as important as us wanting to work with them. I don't think that could be understated at all. I guess there's that element of being able to understand their personal characteristics, the level of self-awareness. Do they understand what those challenges are, the gaps? We're not looking for people that have all the solutions, but as Kevin said, we're looking for people that understand they don't have all the answers, and that they're willing to work with others to get there, and sort of that intelligence and capacity and hustle and grit all come together. So for us, I guess, we do like to get to know our potential founders and sort of potential investor companies as early as possible. And we do have an element of sort of behavioral interviews as we progress through some of the investment processes, because at the end of the day, we're investing in the founder. An early stage investment is a gamble on the founder as much as the opportunity itself. And so that really does form part of the investment decision.
Wonderful. Carl, I'll get to you at the end because yours is a little bit different with the incubator, which is really interesting. So I'm going to jump to you, Isabella. What would you give your advice to the founders that just want to know why? Why can't you just decide today?
So the best short and sweet quote that we always laugh at is that the average relationship with your investor lasts longer than the average marriage in the US. And so, there's going to be ups and downs, and we're typically investing on the up, but really for a founder, you want investors who will continue to support you when you hit roadblocks and when you get punched in the face. And so I would say to founders, it's actually more beneficial to you in a lot of circumstances than to us to really get to know your investors, because it's one thing deploying $1 million or $3 million of first check when things are going well, but can you say to yourself, hand on heart, that that when things don't go well, investors will continue to hit the streets and fundraise for you when you can't fundraise, or get your customers when you're having trouble selling. And I would advise every founder looking for investment to who's going to a venture capital fund to ask the VC if they could speak to the companies that haven't worked as well as the companies that have, because I think the proof is in the pudding, where you have, every VC portfolio has had companies that haven't gone exactly to plan and haven't worked. And you want to know that your investors are going to be there to support you, whatever the outcome of the business is.
Yeah, I love that. For every success, how many have failed? We learn more from our failures than we do our successes, because we're successful. What do we need to learn? But when we're not successful, there's some really hard questions that need to be asked. And then finally to you, Carl, what would you say to those investors? Because you're really getting them right at the beginning. You're getting them at that incubation stage. And just as Vela was saying, you're talking about, are you looking for them to be coachable and willing to learn at that really incubation stage?
Yeah, yes. Look, I'm not a big fan of the, no offense, I'm not a big fan of the coachable word, really. It feels a bit kind of, well, we know everything and you don't. So I personally just try and avoid that. But, I think, we deal with a lot of, engineers and PhDs who have been working on whatever they've been working on for a really long time, and so you've got to be really respectful of that, right? They've put their life's effort into it, and their academic life effort into it at least. And so when we get technology and academics coming to us, we so often see that it's a solution looking for a problem, right? Which is sort of the opposite of what we're trying to look for. Now, that doesn't mean we won't invest. It just means we have to look at it in quite a different lens. So, we're trying to get in, and much earlier to help with the education piece around that as well, and get people, before they're even thinking about becoming an entrepreneur to think of it in a slightly different lens, and then once we sort of see that there is something there, one of the next hardest transitions we see for founders is the transition from building value in their product or their technology to building value in their company. Yeah. And that's a really hard transition for a lot of people, right? Because their happy place is their widget or their technology and their lab and doing that, and so they kind of naturally gravitate back towards doing that. But at the same time, they've got their commercial hat on, and they're trying to build this entrepreneurial expertise, and they don't always go together, and sometimes they work really, really well. So it's an interesting approach, so I think from a founder's perspective, particularly from academic founders or someone who's perhaps not come from the entrepreneurial world quite so much, I think really trying to not with I don't want to reiterate something Kevin said earlier around product market fit and your market and all of that sort of stuff, because that's absolutely fundamental, and your problem and talking to your customers, absolutely fundamental. But also starting to understand the drivers and the economics around it. If you're building a piece of hardware, we invest into quite a bit of hardware. What are the unit economics attached to that? It's quite different to a software play. And again, just trying to move that transition of, is there, is your great product able to become a great company?
Yeah.
But then taking it another step further from an investor lens, we add one more step onto that. Can your great company also be a great investment? Which are not always the same things, right? You often hear talk about a VC backable company, versus what is actually a really good, good lifestyle business, good SME, really for the most part. So then that's the difference probably between the investor lens and the technology or the company builder lens. So, trying to understand that, typically, not always, but typically investors are financially motivated to some degree or another. People want returns. So understanding what the investor return dynamic looks like, I think probably goes some way to help to understand the investor mindset a little bit as well. What does an investor need to see at the back end of it? How does even taking a moment to understand how a fund works, how the fund dynamics work from a investor into a fund, and the returns and the requirements on an investor to give money back, and within a period of time, and and what stage is the fund at in its investment phase. All those are actually really quite important pieces of due diligence that a founder should be doing on their investor every single time, right? Shouldn't be just the investor doing the diligence on the founder. So
yeah,
not sure if I even answered your question there.
It's a relationship. All of it's a relationship, right? I think our final question that will close the panel off today is, what do you want to see from your founders in order to go into the next round of their cap raise? You're starting with me there? Or? Yes.
Okay. What do we need to our founders to see? Look, at that point, again, we've got a range of different companies, but we really want to see the market and the customers being understood much more clearly. We want to see them starting to understand the customer journey, and how does their product map within that. We're really wanting to see the intellectual property strategy built as part of a wider business strategy. They're not two independent things; they're a core part of the same thing. Really understanding the how the team is going to be built, and what does that look like. So just more of the building blocks really, and starting, if we can get some traction, then that's fantastic as well. Real traction versus versus sort of your friends down the road sort of putting a bit of money in. But yeah, so really a bit of traction and a better plan than what we started out with, really.
Yeah, so you want to see them very much shift between that being a good product into being a good company.
Yeah, that's right. Yeah. Shifting away from building their product in the lab to actually, how are we actually going to start selling this? What's our, what are our channels? Who do we need to talk to offshore or, in the industry to start building pathways to either get product in hands or, bring or attract new investors on board as well. So, yeah.
Thank you. And you, Kevin, what would you say to your founders? What do they need to do to go from that £300,000 check to the next million pound check?
So there's no one size fits all. All companies are different. We've built the technology to track their progress and to help them to report to their shareholders. So we are measuring a number of metrics for our companies based on their sectors, their maturity, their geography, and so on. So it's again, it's, for a medtech company, it's going to be FCA approval, and for a fintech company, it's going to be, customer pricing and so on. So those metrics are designed on a deal by deal basis, and for us, what we want to see is progress, right? And it can be measured in different ways.
And you, Vela, what do you want to see in your founders and your companies?
A bit like both what Carl and Kevin said, I guess to an extent, when we make an investment, it's based around a hypothesis at the early stage. So we and investors have a hypothesis, and they're in that sort of maybe first 100 days when we first invest in the company, we might sort of think about what are the metrics, what are the KPIs that we want to see evolve, how do we do our impact reporting. So we put together a bit of a framework that allows us to understand how that startup might be progressing through its phases. And we also recognize that the hypothesis can change. The business model can change and evolve with market demand, circumstances and those types of things. And so it's a little bit of, as much as anything else, progress towards agreed goals, and yet knowing that at any time those goals can shift. And so when they do, it's also looking at it, taking a step back and looking at it almost anew, like a new opportunity, and sitting down and sort of taking almost a beat to reassess and sort of have a look at, is the market still the same? Is the opportunity still the same? Are we still aligned on the impact that we want to deliver? Can we still provide meaningful support and those types of things if there is going to be that shift? But more than anything else, it's progress, and that can be measured in many different ways.
Isabella, do you want to tell us a little bit about how progress can be measured?
Yeah, it different for every company. So not that helpful from a tangible perspective. But what I will say is probably two things come to mind, and there's an assumption that obviously the business is progressing, but the two things we probably look for is under promise, over deliver in what was set out to begin with, and then the second is founder integrity, which is not everything is going to go to plan, but if you can see that the founder has integrity in what they're doing, integrity in how they treat their staff in challenging times, the assumption that the business still can continue and still an investment. I think those a good investment, those are the two things that I would say. There has been decisions that have been made because not that we don't think the opportunity that is there, but throughout COVID, the way that a company dismisses staff is something that we will look at in kind of forming a decision which goes beyond just metrics, but really how we think that the founder and the kind of founding team treats people around them, both the customers and their staff.
Is it a red flag for you when there's a big staff turnover?
Yes. One of the things that we look for is tenure, like average tenure in a company, reasons that people leave. We do interviews with current staff and previous staff. There's always going to be churn when companies raise money, because you're going from a business which is probably like a great lifestyle business growing at X%. Suddenly you get $2 million and there's going to be like a significant cultural change in the business. So there's always going to be that churn, and that's something that we don't worry about. But if there is significant churn within the business because of certain issues within the founding team or culturally, then absolutely.
We're good. Okay, everyone, thank you so much.